Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. This is the first video in a series that we're doing designed to teach you the perfect stock alert method of technical analysis. Let's begin. Okay, right off the bat, we're going to look at the disclaimer. The information provided here is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. Okay, step one is paramount. If you do not do this first step, everything you do from that point on will have all kinds of problems in it. So it's important that you begin with step one, which is market analysis. The objective of PerfectStockAlert.com is to stack all the odds in our favor, and thereby increasing the odds of our success in every trade that we make. The first thing we've got to do whenever we're doing this is recognize what technical analysis is and is not. Technical analysis is the study of buy and sell pressure. Therefore, any news that's out there has already been weighed upon or bet upon. People have heard the news, they believe it to be true or not true, or going to affect the market or not, and they've cast their vote with their dollars, either buying or selling the market, okay, based on this news that's out there. So in theory, all the news that's already out that we all know about is already reflected in the price activity that was on the charts. Having said that, we know that there are multiple trends, counter trends, sorry about that, counter trends and true trends in every day-to-day market activity. We have down days in an uptrend, we have up days in a downtrend. These are common. What we want to determine is what is a true trend, and then work with that true trend to thereby make our trade successful. Let me give you some examples. If you go into the market and you see, or maybe you've been doing this for a long time, you've had this happen to you, you see a bullish setup and you go and you buy and it falls apart on you. What caused it to fall apart? Now, if you do it once or something like that, you might think it was, I don't know, one thing or another. But if you do it repeatedly over a long period of time, you'll realize that they will consistently break down, bullish setups will consistently break down in a downtrend or in a bear market. And the other side of that coin would be to say bearish setups consistently fail in an uptrend. Okay, so you want to work with the overall market, remembering that 90% of stocks follow the overall market up, down, or sideways. So it's important to stack those odds in your favor. If you can do that right, if you read your overall market correctly, you will be able to stack the odds in your favor from the word go. So let's begin with this market analysis. The first step of market analysis, we'll go over the indicators that I'm using. But the first thing you have to do is start with your major market analysis. And for us, I live in the U.S., I trade in the U.S., so I'm going to analyze the Dow Jones Industrial Average. You could do the same thing with the NASDAQ, the S&P. Any major U.S. market would give you an idea of what the overall trend is for your market. And then from that point, I would go on to the selection process and the timing of the entry point and the exit point, so forth and so on. All right, let's begin here. First, it's important to note that long-term trends are more powerful than short-term trends. Therefore, when I begin my analysis process, I'm looking at a 4-year weekly chart. That's what you're looking at right now. This is a Dow Jones Industrial Average. This is a period of 4 years, each candlestick being 1 week. Okay, this is more powerful than a 6-month daily chart. So I'm going to start with this, and then I'll move into the 6-month daily. But I'm going to begin with a long-term chart. The first thing to note about technical analysis is that price activity is your primary indicator. It holds more weight than any other indicator. Okay, the only one that's even comes close to that is going to be volume, and volume is important because it's going to substantiate the moves that you see. Okay, we'll discuss that in a minute. Everything else, from the RSI indicator, the slow stodge, the MACD, everything else that I use is all secondary. Okay, before we ever look at anything else, I want to analyze price activity and volume. Okay, so let's start with that. The first thing to determine is what is the overall trend of the market. Okay, it's important that you take into account all price activity of the 4-year period. Do not just go look for one point and another low point and say, aha, uptrend, let's go. That would be a flaw. Okay, you want to take into account all the activity on the price. That means find the highest point, right, of the past and the highest point of the present. All right. And then we can draw a trend line across those 2 points. Find the lowest point or the previous lowest point of the past, which is back here somewhere. If you pulled the chart out further than 4 years, you'd see there was a low point back here. All right, you could draw a point from there and another one currently from here. Okay, this fish here. We're seeing an overall major downtrend here. All right, now in theory, this could just do like this. Okay, like that. But there, we don't have to get into all that. And you could still also look at this and say, well, maybe she will consolidate here and then break out to the upside. We could look at all that too. So for now, we're just looking at what is on the chart, and then we'll determine later what's going to be. Another method for analyzing price activity, which is much more simplistic but just as effective, is to note low points. Okay, you have a low point back here, another one here. Notice higher than the previous one, another one here, higher than the previous, another one here, higher than the previous. And this continues this uptrend. Okay, we see a move here, pull back, higher high, pull back to a higher low, higher high, pull back to a higher low, moves up here, fails to break, and goes lower. At this point, it took out this low point. By taking out the low point, you now have a series of lower lows. This creates the downtrend. At this moment, the price of activity at this high is what bulls have to take out to reverse the trend. If they do not do that, you remain in a downtrend. Right? Note the series of lower lows and lower highs. This process continues until it reverses. Okay? And you get a series of higher lows, followed by higher highs. Higher lows. This continues until it stops. Okay? Note the low point here. A little bit off there. Low point right there. Okay? Was taken out right there. That means you now have a series of lower lows. This is now the line bulls have to take out to reverse the trend. At the moment, we are in a downtrend, very clearly defined by a series of lower lows and currently lower highs. Okay? Very easy. We are in a downtrend. That means when the market's in a downtrend, we're going to go look for short opportunities or situations that allow us to sell the market and individual companies. If we were in an uptrend, we would not do that. We would look for long opportunities in the market. We want to work with the overall trend, remembering that 90% of stocks are going to follow the overall market trend, okay, the true trend. So that's important to note. This is the key and the foundation that you work from with the Perfect Stock Alert method of technical analysis. Now, as I've said before, every price activity must be substantiated with volume, must be confirmed by volume, buy or sell volume, depending on the move. Okay, well, back here you had a series of higher lows. We're up in an uptrend. Okay, and then right here you got taken out, making a new low point. This gives you a downtrend. Okay, you'll notice at this breakout right here where they failed, an increase of sell volume superseding previous buy volume on all counts. Okay, you'll also notice you're starting to see an increase of sell volume before the breakdown actually happened. This is common. You'll notice sell volume continues to increase until it peaks out. It will be peaked when everybody's in who's going to be in, and it will not shift. The trend will not turn like it did here without volume. You need substantial volume to verify it. The volume must supersede the previous volume or engulf it, just like you do with the candlestick formation, the price activity. You want to see volume to confirm that. The moment you've got that, you know buyers have stepped in, put a floor in the market, and you expect a reversal. Okay, this will continue. The trend will continue to move to the upside until buy volume fades, until it's get to a point that it's so overbought people don't want to buy anymore. You will notice buy volume decreasing the entire time. All right, it's trending lower and lower and lower. This will continue until sellers come in and supersede the previous buy volume. All right, that's exactly what happened at the moment we broke below this point, right there, right there. Okay, once that had happened, you notice it was substantiated by sell volume. We know that this is then going to remain in effect. Again, we're expecting sell volume, like it did back here, to increase until we peak out on the downside. Okay, but again, it's important to note that price and volume confirm one another. They do not argue with each other. Okay, it's very important that you always make sure you analyze multiple indicators. By doing that, you're increasing the odds of your analysis to be correct. And it's important to do that. You can get a false signal from one indicator or another indicator, but if you stack 9 or 10 indicators in your favor, you've got, you know, 9-to-1 odds in your favor. So it's really important that you, assuming you were analyzing 10 different indicators, if 9 of them were telling you the same thing and one of them was off, you'd have 9-to-1 odds stacked in your favor that you're correct. And that's what you want. You want to stack those odds in your favor. This will increase your success, decrease your failure, and thereby allow you to increase the number of successful compounded trades you can make. The third indicator I use and I rely on heavily in the long-term analysis of my charts is the RSI indicator. We have an entire series of videos on our free website at perfectstockalert.com designed at teaching the RSI analysis, how to read this. So if you haven't already checked out those videos, they're all there for you. You can watch as many times as you like. But the basic premise is to watch for a divergence here where price activity may be trending higher, making a series of higher highs, yet the RSI hitting the above 70 line, which is extreme overbought. Alright, let me remove that. Sorry, kind of blocked what I wanted to show. Alright, starts to form a series of lower highs at the same time that price activity is showing higher highs. This would be a bearish divergence. You would not want to trust price. It would be telling you that price activity is losing the upward momentum. Even though price continues to move higher, the momentum indicator here is showing you that it's fading. And so it's actually on hot air or overly optimistic, and these prices will not be sustainable, and that would be a good signal of a reversal coming up. On the way down, exact same thing. You've got price activity right here forming the low point here, here, and here. All right, showing a downtrend. At the same time, you got below the 70 line, below the 30 line on the RSI, which signals extreme oversold, and you'll notice here you start to see a series of higher lows. This is the exact same thing, only this is referred to as a bullish divergence. You'd want to be a buyer during this time period. Okay? And again, had you watched for confirmation by the volume activity, you would have been buying right there, dead on. Okay? Very perfect. Then you expect this to continue until you get above that 70 line again, which you did right there. Note this was just before the flash crash. Okay? Any bounce to the upside would simply give you a move somewhere to this point. Any kind of a failure below that 70 line is going to create that downtrending series that you're looking for on the RSI, which would be further confirmation that you want to be shorting or selling this market in anticipation of a double dip. Okay, it's important to note. Another common indicator I use and put on all my charts is the MACD, Moving Average Convergence Divergence. You'll notice this can be used for confirmation. That's what I use it for, is confirmation of bearish or bullish divergences. Back here we had a confirmation of a series of bearish divergence trending lower here as price activity was still trending higher, which would be agreeing with the RSI saying you had a bearish divergence there. That's important to note. Also, the bullish divergence that we showed you on the RSI would be signaled right there as well. It's important to also note. And again, here and here, right there, while price activity was trending higher at the same time just before the flash crash. Okay, very cool. Again, I use this for just like a backup indicator for spotting divergences. Typically, I'll see it on the RSI, but I like to get it confirmed, and also the MACD can on occasion pick up signals that maybe is being missed by the RSI or the slow stotch, which again, the slow stotch can be used as well, but I like to use the slow stotch for my timing as opposed to my main signals for divergences. So let me show you what that looks like. Okay, once you have determined the overall trend, the current trend of the market, remember back here you had high point, high point, high point, high point, new low, series of higher lows right here, and then a lower low right there. So you were just trending like this, and then you shifted, okay? Just like that. So this continues until it changes, all right? You get a series of higher lows, okay, higher highs. Okay, so we just continue doing this process until we get taken out. We've already determined this is in a downtrend. She broke right there, okay? And now she's in a downtrend. So whenever she's in a downtrend like this, you don't want to just jump in all willy-nilly and start shorting things. You want to actually wait and time yourself, time your way into the market, which means you want to use the slow stotch, which is what I use all the time, to time my entry point. If I'm in an uptrend like I am back here, whenever the slow starch pulls back down here to the 20 line, I want to look for my entry opportunities in the market. All right, as long as that's in an uptrend, that's what I'm going to be doing. Okay, every time she hits the 20 line, I'm looking for those really good quality entry points. And again, if the signal's being given on the long-term 4-year weekly chart, it's an even stronger signal. So you definitely want to be using those. Okay, and until the trend shifts, that's exactly what I'm going to be doing. Every time she does that, I'm going to go out there and buy. Now in this case, she pulls back down here. All right, right here, but she takes out a previous low. I'm no longer bullish, so I do not buy this move right here. I wait for this. Move back up here to slow starch. I go short. Right there. That's where I want to be shorting. Okay? And you get this payoff right here. When the slow starch pulls back down here, we'll talk about timing on another market chart, a 6-month daily. But whenever she pulls back down here, you start looking for a bounce. You're expecting a bounce. So you would advance your stop loss limit. Okay? You could do that to protect yourself. We'll talk about that more later. This main thing is just to get the idea of what you're doing in each individual type of market. Okay, so now you're in a downtrend here. This continues. You get a reversal here. All right, that's great. And now you shift back to the downtrend. Okay, right there you broke through. You're now in a downtrend. What am I doing? I'm waiting for the slow starch to pull back up to the 80 line like it's at now, and you want to go short the market. All right, so you know all your timing on your long-term chart is in line. It's telling you because it's slow starch, is because the overall price activity is on the downtrend. You want to wait for the slow starch to get above the 80 and then go look for your short opportunities or your inverse ETF opportunities to bet against the market. So that's exactly what we're going to do. All right. Very easy, very cool. This is where the premise and the start of the foundation of the perfect stock alert method of technical analysis starts from. You've got to work with your overall markets if you want that strength to protect you, to increase your gains, and so forth and so on. This is the premise, and you cannot bypass this. You really got to start with your market analysis. I cannot stress that enough. Okay, pretty cool, pretty simple. We're going to go on to selection process and confirmations and other signals, so forth and so on, and timing your entry point, exit points, and all that stuff in later videos. This is the main video here. I just wanted to show you where you start. Always start with your major market analysis. And again, you can take this and go even deeper into it. You can start analyzing other markets. We could start analyzing the NASDAQ for confirmation and the S&P and so forth and so on. But for the most part, you're not going to have a bull market in the NASDAQ and a bear market in the Dow Jones Industrial Average. Ultimately, they're going to roll together, with some variations, but ultimately they're going to be working together. So once you've got one down, if you go back and look at others, you're going to see typically the same scenario being drawn out there. Again, this is the primary video. You've got to start with this. Once you have this, everything else you do will be based on this. So it's important that you get your analysis of the markets right. If you do that wrong, everything else is going to be a headache, all right? And you'll notice it pretty quick. So definitely start with this video. Make sure you got your market analysis figured out properly, and from that point on, you could build from there to the selection process, finding yourself opportunities, timing your entry points into them, and trading, so forth and so on. So let's move on to that. A quick look at our disclaimer. We'll close this video, and then I'll go make the second video, okay? Awesome. Our disclaimer, read it and weep. The information provided here is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. I thank you for your time. God bless. I'll see you in the next video.